Hi, everybody. Chris Engelbert with Engelbert Financial Advisors in Allentown, Pennsylvania. And normally we try to do our updates near the beginning of the month, but there was something going on and we're a little bit late because obviously there was the Super Bowl and the world champion Eagles obviously won the Super Bowl. So that's why we're late with our update for February, but let's dive right into it. So what's on every investor's mind right now? Tariffs, tariffs, tariffs. Now, it doesn't really matter your political persuasion. What you have to remember about tariffs is that they're a negotiating tool. The question is going to be is what is the effect on the US stock markets as far as tariffs go? And it's a little bit early to tell right now. One of the things that did happen in the month of January was that the S&P made a new all-time high at 6128. But if you look at the right-hand side of the screen, you can see that since then, we've had a sell-off, and it's because of the tariff headline. Nobody quite knows how that's going to affect the stock market literally for the rest of the year. But one of the other things that we want to point out is that we are beginning to see a big shift away from the Magnificent Seven. So the Magnificent Seven are Amazon, Apple, Meta, which has been on an incredible tear, NVIDIA, Tesla, Google, and obviously Netflix. And if you look at what's going on this year, we think that this is going to be very similar to what happened in 2022, where large cap growth stocks, and i.e. the Magnificent Seven, obviously underperformed that year very severely. Well, what we think is happening is that investors are finally realizing that the price earnings ratio, price to cash flow, whatever measure you want to use for valuation on these 7 large cap technology stocks is stretched to the limits of the imagination. So as of the time of this video, you can see that the Mag 7, there's an ETF, exchange traded fund, that you can buy, MAGS, is down 22 basis points for the year. But lo and behold, look at what's been going on. We use the Vanguard Value ETF, VTV, as a proxy, and you can see that's up over 4%, while the S&P 500 is up about 3% as the time of this video. So the takeaway that we want to talk to you about is the fact that investors are beginning to realize that maybe they better diversify away from the Magnificent Seven stocks, which obviously have been incredible performers the last 2 years. Now, let's talk about interest rates. We saw interest rates peak in January at 4.8%. We then saw a sharp decline in interest rates down to 4.5%. But most recently, we got a hot inflation number, both a CPI and a PPI. So CPI is Consumer Price Index, PPI is Producer Price Index, and you can see that that caused the 10-year to back up to 4.6%. Now, we still believe that there's value in fixed income this year because you are getting interest rates on longer-term bond funds of anywhere from 5.5% to as high as 7%. We think that's very attractive. So we believe that anytime interest rates back up, investors have to look at buying longer-term bond funds to take advantage of those high yields. So just to sum it up here, and we're going to make obviously this week's video a little bit shorter. The S&P 500 did make new all-time highs in January, but the tariff talk has caused a decline. The 10-year did see a peak in yields at 4.8%, only to sell off and then back up. But again, we think the big story this year is that value and dividend stocks are going to be leading the charge for 2025, and we think that that's going to be the place to be. Now, one of the other things that we wanted to talk about is what we love to say is something called sequence of returns. Whether it's monthly returns in a stock market or quarterly returns, many investors don't realize that their investment experience depends upon the sequence of returns. So say, for example, you invest a whole bunch of money in the stock market and it declines by 10% in the first quarter that you have that money invested in, obviously you're going to have a negative sequence of returns. So one of the things that we watch is what's been going on with the stock market on both a monthly basis and a quarterly basis. Now, we think that the first quarter of 2025 could end up actually being a negative return quarter because from a statistical standpoint, 8 out of the last 9 quarterly returns for the S&P 500 have been positive. And so if obviously you're a statistician or looking at returns like we do, that raises the probability that the first quarter of 2025 could end up being a negative return. And guess what? One of the big bets as far as the Super Bowl goes was that Saquon Barkley was going to score a touchdown. He did not score a touchdown in the Super Bowl, and many bettors that had a parlay ended up losing money because Saquon Barkley did not score a touchdown. Obviously, everybody else on the team scored touchdowns, but again, those are some of the things that we look at. So just thought I'd throw a little Super Bowl fact in there for you. And again, in a couple of weeks, we'll be back with our first of the month update for March. Until then, everybody take care and go Eagles, go.